I'd like to thank the organizers for inviting me to speak at this high-profile SIAS event. I think it's a very timely to have these discussions as we come out of the COVID period. And of course, the age of uncertainty, which is the theme of the discussions over the next coming days. I think, with disruptions, you get uncertainty, you get bumps in the economic environment, bumps in the industrial environment. And I like to think of corporate governance for corporates to be giving some element of checks and balances. I look at it as analogous to the suspension and brake system of a car, to give you a smoother ride, to keep in control the overall direction, and to keep the car in the right path as various obstacles come in the way. I think that's the analogy that I have usually on corporate governance. In relation to this, I'm very pleased to be able to speak today about BlackRock, a little bit about BlackRock, what we do globally, what we do in Asia Pacific, about the stewardship and sustainability focus that we've had, and then to conclude with some suggestions, recommendations on what I consider that boards can do to advance ESG generally in the region, and to some extent in focusing a little bit more in Singapore. So thank you. I think the slides are in the right slide now, a little bit about BlackRock. We were established in 1988 by 8 founders, including Larry Fink, our chairman. And in the 33 years, we've grown our assets from 0 to 8.5 trillion US dollars at the June 2022 middle of this year. So we are the largest asset manager globally. We have clients in over 100 countries. We serve over 100 plus central banks and sovereign wealth funds, and have over 1 billion savers and retirees who are our clients. Of our assets, about 50% is in equities, public market equities. And of that 50%, 90% is in what are generally called passive investment strategies. So if an investor wants to buy into Southeast Asia, ASEAN, Singapore, or China, then we would almost certainly have an ETF which tracks that market, tracks the relevant index, and gives low-cost exposure to particular markets. Now, despite this passive style of investing, of stock selection, our stewardship is active, and that's what I will try and show on the next slide. So BlackRock Investment Stewardship is the team I lead for Asia Pacific, based here in Hong Kong. Our team essentially is responsible for voting the shares in the BlackRock portfolios. And even if the selection of stocks is passive, following indices, but our voting is active. And we target to vote 100% of the votable shares, and by and large, we get to 99.9% voting on the shares that we're eligible to vote for. And to inform our voting, we have meetings with senior corporate representatives, CEOs, CFOs, head of sustainability, head of IR. We also try to get to independent directors to get an independent perspective on how the board discusses and comes to decisions that they've made on policy. And we participate in consultations and public discussions like this one to provide inputs that help to promote good governance and sustainability practices at investee companies. I would emphasize that our portfolios are not BlackRock capital. This is not BlackRock assets. These are funds for our clients, funds of our clients, and we are investing and have a fiduciary responsibility for our clients. Now, that fiduciary responsibility in terms of stewardship is highlighted in the map on the next page. So we take this fiduciary responsibility very seriously. We have the world's largest stewardship team, about 70 members globally, of which 22 now in Asia Pacific, in offices in Japan, in Hong Kong, in Singapore for ASEAN, and we cover South Korea from Singapore, and we have 2 persons in Sydney. We also have, in addition, a person in Shanghai who joined us a few months ago. So we have 22 persons dedicated to stewardship, dedicated to engaging with companies and then using those discussions for our voting. And the effort in stewardship is a huge effort. We undertake about 3,600 engagements globally, of which 1,000 plus in Asia Pacific. And we have to vote at about 17,000 meetings globally at the AGMs and EGMs. On the next page, our engagement priorities. Next slide. We have 5 main engagement priorities, and these priorities have basically been, we tweak them slightly for emphasis at the start of each year. But essentially, these 5 priorities have been what we've had for around 10 years now. And if you look at these topics, I would say it is G, GG, and ENS. We have 3 topics on governance, and 1 main topic on environment, 1 main topic on social issues. So governance, the topics that we have include board quality and effectiveness, strategy, purpose, and financial resilience, and incentives, i.e. compensation to be targeted for managers to be thinking about long-term value creation. We have climate and natural capital, which I think is the 2nd box over there. And then we have company impacts on people, which I think is the 5th box. And that is the staff, the workforce of the company, and how the company improves the capital management, as well as the company impacts on the community. These are 2 aspects on the S side that we think are important. Next slide, please. This is a quote from our chairman, Larry Fink, who writes an annual letter to CEOs of investee companies. And in his 2021 letter, Larry wrote that every company will be impacted by the transition to a net zero economy. As this transition accelerates, companies with a well-articulated long-term strategy to address the transition to net zero will distinguish themselves with their stakeholders and inspire confidence that they can navigate this global transformation. Larry also highlighted that we are at the beginning, at the cusp of a major reallocation of capital towards companies that take sustainability seriously. And if you look at the next slide, you can see the shift and the growth of funds into sustainability portfolios. From 2018, when sustainability portfolios globally, and this is the overall fund management industry, not just BlackRock, $1.8 trillion in 2018 has more than doubled. By last year, it was $3.8 trillion. And if you look at Asia Pacific, it has roughly quadrupled from a lower base, from around, I think, 30 odd billion in 2017, 2018, and it has grown to 120 billion as at middle of this year. The growth has come off. 2022 has been, as they say, a challenging year, which is a euphemism for a very tough year. The growth in sustainability funds has slowed from 21% growth last year to 4% growth as of the middle of this year compared to a year back. But that 4% growth is still 4 percentage points higher than the overall global investment fund industry growth. Global investment fund industry is about flat, and sustainability funds continue to grow. And that shows you that this shift in capital towards high ESG companies is underway. It will continue. And the relevance, I think one of the reasons and incentives for companies to take it seriously is that companies that have good ESG credentials are eligible to be in these portfolios, these ESG-driven portfolios or sustainability funds. And of course, they're also eligible to be in other funds as well. So they get a greater pool of capital compared to companies that are not taking ESG seriously, which are excluded from these sustainability stroke high ESG funds. And so that shift of capital means higher valuations for the companies that take ESG seriously. Higher valuations mean lower cost of capital, and help these companies in their acquisitions and M&A. So a few of the takeaways from this slide and the earlier slides. Climate risk we see as investment risk. I think that's not, that's true of BlackRock, that's true of the investment industry globally. The net zero journey has started, but it will be uncertain, it will be uneven. This transition, we think, presents extraordinary investment opportunities and risks as well. Now, if you look at the next page, our fiduciary responsibility, this has evolved over the last 10 years. We take this as our responsibility for our clients. As I mentioned earlier, what we're investing in the BlackRock portfolios is not our money. It's our clients' money, and we have a responsibility to manage that money in the best interest of the clients. Going back 10 years, in the early years that Larry wrote his letters, he emphasized that companies needed to have long-term value creation, long-term emphasis, to be the goal of managers and the boards. In 2018, Larry emphasized that companies should have a sense of purpose, a fundamental social need that guides the company, the why for its existence, and guides the company for its long-term strategy. And then since 2019, 2020, greater emphasis on sustainability and climate issues. And we emphasized in the 2020 and 2021 letters that climate risk is investment risk. There is this tectonic shift of capital towards companies taking sustainability issues seriously. And in the 2022, the letter from January this year, Larry emphasized that capitalism allows efficient capital allocation through market signals. And the corporates have a duty to attract capital in a responsible and sustainable way. That we at BlackRock, we focus on sustainability because that is essential to long-term value creation. When you think about long-term value creation and sustainability, these are two sides of the same coin. But we do it because this is in the interest of our clients. We do it because we are capitalists. And I'll say that quite clearly. We do it because we're capitalists, not because we are tree huggers, even though a lot of us have environmental inclinations. If you go to the next slide, page 10. We started engaging with companies on climate issues in 2020. We created initially a list of about 450 companies in the high carbon intensive sectors. We expanded that list in 2021 to just over 1,000 companies. So BlackRock has exposure to about 15,000 companies globally. And of those 15,000 companies, about 1,000 make up 90% of the emissions in our total equities portfolio. So 90% of our GHG, Scope 1, Scope 2 emissions comes from these 1,000 companies that we put in the climate universe. We've also included the banks in the climate universe, even though the banks themselves, their operations don't emit a lot of carbon, but financed emissions for banks obviously is very relevant. So these 1,000 companies, we consider our climate universe. And if you look at the next page, essentially what we're asking of our companies is TCFD reporting. Now, basically, we think that TCFD reporting is the starting point for companies to provide investors with how they are transitioning, how they're navigating to a low or zero carbon economy. And we need disclosure from companies that is material, i.e. relevant to the business, but also comparable from one market to another market. And that is why it's important that the disclosures be by a global framework, which TCFD provides. But, and if you look at the TCFD framework, there are four main pillars, which include governance, strategy, risk management, as well as metrics and targets. And for metrics and targets, we're looking for a long-term target, commitment to being net zero by 2050 or so, as well as medium-term targets, because 2050, very few of us will still be, running companies, etc. But in the next 5 to 10 years is when people in this room can make a difference. And companies, the senior management of the companies can make a difference. So we're looking for also the next 10-year, i.e. medium-term targets from companies as well, and focusing more on scope 1 and scope 2. If we have time later, we can discuss our views on scope 3. If you go to the next slide, how this is translating into our voting. In the last 12 months of the voting period to June of this year, we voted against 234 companies for disclosures and or practices that we thought were not up to scratch. And essentially where the companies are not yet reporting by the 4 pillars of TCFD. And we basically selected 176 directors of these 230 companies. About 176 of these directors at these companies we voted against their re-election, holding them accountable for the lagging disclosure of these companies. And then there were another 70 or so companies where we voted against because we supported shareholder proposals of other activist proposals that came at shareholder meetings. If you look at the next slide, page 13, the area that BlackRock and our investment stewardship team here in Asia, the area that we vote against companies more often than any other area is on independence. And if you look at that figure on the second column there, I think in red, we voted against 1,100 companies in Asia Pacific on independence issues. And that compares with only about 200 companies in EMEA, Europe and the Middle East, and Americas. In each of those regions, we voted against about 200 companies each. But in Asia Pacific, we voted against 1,100 companies because of independence issues. And that translates to about 25% of companies in Asia Pacific we voted against because of various concerns on independence on the board. And by the way, Singapore is give or take around that 25% as well. And other markets in ASEAN, there are some markets in ASEAN where we voted against 50 to 60% of the companies in our portfolios because of independence issues. So independence of boards, I would say, is still the single biggest issue of governance in this region and in emerging markets generally. So if we go to the next and final slide, some recommendations on what boards should do. And I would say that, this is my views rather than BlackRock's views, but there is obviously a large overlap. It's my views coming from the experience that I've had in the stewardship team at BlackRock for the last 4 years. And prior to that, about 25 years as a sell-side analyst interested in governance issues regionally. I think if we go through these, I think if you think about what investors' expectations of the boards are, we see the important function of the board as helping to set policy for the company, helping to identify the risks, monitor the risks and how the company is managing the risks. And related to that is oversight of management. We think these are 3 very important core responsibilities of the board. And to undertake these responsibilities, we think it's incumbent on directors to be well informed on issues that relate to the company, on the risks and opportunities generally, but also the sustainability risks and opportunities as well. What are the issues? What are the challenges for the company on sustainability and on business operations overall? These, I think, are questions that incumbent that the board be asking management. But it's also very important, the second bullet point, to be asking the relevant consultants. The boards should be having discussions with consultants as well, experts on environmental sectors, experts on labor issues, to get an external view of the issues that the company is facing, so that the board is in a position to be able to challenge management. If the views that the board is getting are all the views from the management, papers by management, papers by the internal sustainability department, the internal audit department, etc., then the board is using information for the management for oversight of management, which defeats the purpose. So we think it's very important that the board also opens itself to getting views externally on issues that are relevant for the sector, for the industry, and therefore questions that the board should be asking of management. And relevant questions to be asking management, we think the reporting framework helps to identify the questions that are relevant and pertinent to be putting to questions. And that's where TCFD reporting is a starting point. It talks about scenarios. If the world is to stick to a +2 degrees or +1.5 degree increase in average temperatures globally in the next 30 years, what does it mean for this business? What does this sector have to do? How well positioned is the company? So asking the right questions gets supported by a reporting framework that helps to put these questions in focus. And that is why it's important to have these reporting frameworks. I've put down sustainability KPIs as one of the bullet points there, but there's some ambivalence on this topic. And the problem is that too often the sustainability KPIs are too soft. I've met a company, a bank in the region, which had a goal on sustainability loans. But the initial target when they set this 5-year goal about 2 or 3 years ago, it turns out that initial goal was too low. And by the second year, they were already hitting the annual run rate of sustainability loans. So basically from year 3, 4, and 5, all they needed to do was achieve what they were doing in year 2 on sustainability loans, and they would be meeting their 5-year loan target on sustainability/green loans. But in the meantime, the weighting of that KPI on sustainability increased from 5% in year 1 to 20% in year 3. So basically in year 3, the bank didn't have to do anything more on sustainability loans, but 20% of the CEO's KPI would be met. So that is, I think, a major issue. A lot of corporates find it a bit difficult because you have one group suggesting sustainability KPIs, the sustainability team, and you have another group, another committee, the remuneration committee, that tries to put it into the KPIs, and the attention and weighting that they put will often be disconnected, and then in the end, management will advise in sort of a middle way, but the middle way generally is often too soft. Finally, the last 2 points here is to emphasize what I was saying earlier, that the good governance is moving away from a compliance mentality. Too often, we see companies in this region thinking that if they follow the rules, SGX rules, MAS regulations, company law, as long as we've got our head of legal, our company secretary, they're telling us this, we're following the rules, then we're okay. But good governance goes beyond that. It is not just compliance. It is for the board to have an active and interactive processes to be able to exercise their responsibilities effectively. The responsibilities that I mentioned at the outset: monitoring risks, oversight of management, helping to determine policy. Right? For the board to be able to play their role effectively, it is crucial that directors are speaking to people outside management to form an independent view of what makes sense for the company, and then to be engaging and interacting with management, challenging management every now and again on what is in the best interest of the company over the long term. And so we think it's important that companies have a lead independent director, which Singapore regulations recommends, and quite a few Singaporean companies have a lead independent director. And it's very useful for that lead independent director to be also interacting with investors. It could be at your AGM, where you have maybe 10 or 15 minutes for the lead independent director to answer questions to the shareholders, and or engagement meetings with stewardship teams like ours or other investors, so that investors, I mean, the information from the independent directors is that stewardship team is looking for is not price sensitive on, you know, is the company going to go into this business area? Are we going to close down that business area? Is there going to be a special dividend? That's not the interest in discussing with the lead independent director. The main issues with the lead independent director is how does the company come to the decisions that it's made? How does the board look at refreshment of the board? How does the board look at the skills metrics? How does the board look at succession of the CEO, and also refreshment of the board? How does the board make the decisions on compensation? It's the how questions to understand how the board works, which is what investors and stewardship teams are looking for in the interactions with independent directors. And there is already quite a few lead independent directors. In our experience, when I've had a few meetings in Singapore, and the team that we have in Singapore, we are already having some meetings with lead independent directors. We would encourage more companies to offer their lead independent directors for meetings with investors. And again, it is for two-way direct communication, for investors to understand how the board makes the decisions, and for the independent directors, for board members, to get a direct representation from investors of what the market considers to be the key issues for the company. So let me wrap up there, that I think ESG issues is a long-term journey, that it'll be uneven, it'll be uncertain, there will be bumps on the road, but good governance is key for the companies to be navigating that journey. And key to good governance is moving a step up from compliance to a more holistic and interactive engagement by directors and the boards with their overall stakeholders, not just with management. I think those are the key points that I hope I can leave you with, and we'll be open to a discussion later in the panel.